If there were an algorithm, wouldn't it operate under the framework upon which it collects its data from a defined range? And where would that data come from? A beginning point and an ending point during market hours. Since 9:30 opening Eastern time is the regular trading hours opening range beginning of that new regular trading hours session, we have to pay attention to what's going on just before that 9:30. And I've been teaching for decades about the 2-hour window right before 9:30 opening, specifically the pre-session, 7 a.m. Eastern to 9 a.m. Eastern. You can make the entirety of your career just focus on that little time window of 2 hours. You don't need to do anything else. No other sessions. You don't even need to trade 9:30 opening or the AM session. You don't need to do the PM session, London, Asia. You don't need to do any of that. If those 2 hours are hours of the day that you can operate under as a trader. But I'll leave that up for you to determine. Okay? I'm not trying to push it or sell it too hard. There are times when that 2-hour window is advantageous to be a participant in, and then there's others where, based on what it's showing you, it's going to lead to a very wonderful, eventful driven morning session. So let's begin with level here. That's an old low. Move back there. That's those relative equal lows I talked about yesterday. And if we add buy side amount, sell side efficiency here, trades down here, and it rallies up. And right here we have a breakaway gap. And we have a small little buy side amount, sell side efficiency in here, trades to it there, rallies up. We have a inversion fair value gap, trades to it there, extrapolates to the upside. Then we have another inversion fair value gap right here. And look how it's gyrating around its midpoint. And finally, it goes to the upside, comes back down. Buyers are not allowed to go in the lower half now. Rally one more time, trades into it there, and explodes to the upside. And we have another inversion fair value gap here. Builds up momentum right there on that candlestick low. And it rips up above the buy side liquidity. And after taking the minor sell side liquidity here. So right away, you got to take your attention back to that little area right there. Pre-session, 7 a.m. Eastern time, 9 a.m. Eastern time. It's a time-based range right before the regular trading hour session opens up. When we include that detail, and these two little red lines delineate upon which the very moment that the algorithm will refer back to this range where it will collect its data. So when we have this like this, and we don't have a time-based range that defines a specific dealing range, okay? Any old range is in and of itself not important. But when we look at very specific time-sensitive ranges, then it means a whole lot. So why wasn't that important? Because it's not the time range I taught you between 7 o'clock and 9 o'clock in the morning. Inside this little shaded area, you went on the highest high and the lowest low. And the comments were saying, you didn't know that low was there yet and it was going to not go any lower. You didn't know that. Well, what are you talking about? What's this little red line indicate right there? It's 9 a.m. That's the end of the 2-hour session of 7 a.m. to 9 a.m. Everything shaded in that box here, it's finite. Now we can start using this range and derive specific price points. Okay, so this is the multiplication table. Okay, the canvas at which we want to start looking for the horizontal price axis, where the price is going to be. This is the time aspect. Okay, so we have time. We're taking a sample set of all the data out of a particular trading day. So 7 o'clock, 8 o'clock, 9 o'clock, those 2 hours of trading. It's a wonderful opportunity just for you to be a trader and be done, or you use it for key information that will warrant more attention on very specific price levels when time agrees with it. Now, I'll get into that, okay? So if we then add the fib to that range, what I've done was I've taken the fib, I've anchored it to that low, and I've dragged it all the way up to that high. That's the highest high. That's the lowest low between 7 a.m. Eastern Time and 9 a.m. Eastern Time. Not complicated at all, okay? Because I expected price to rally higher because it drifted lower all during the 7 a.m. to 9 o'clock session. And because I felt that 28,400 was going to get tagged, we've traveled a lot on the upside since FOMC. And it's Friday. They're going to do a deep retracement against that. And it makes sense for it to rally up and take out that buy side here. And if you look at this high at 7 a.m.'s range to 9 a.m. range that's shaded here, that high is slightly lower than that one. So doesn't that make this relative equal highs? Sure it does. So if we can go down and take out this minor sell side here and then close the 7 to 9 a.m. time-based range, so now we have a very specific range upon which we can grade it. Okay, so I'm going to show you. I'm going to take the fib again. There it is. We're going to anchor it right to the low, and we're going to draw up to the high right there and drop it. Go into your fib settings. You should have a negative 0.5 right there. Watch right up here. Okay, see that? That's a projected daily high. Okay, so now lower quadrant, upper quadrant, octant, 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 and final octant. Okay, and now we can go now at this moment right here at the end of this. Okay, at 9:01, any PD array that forms and anchored to that forms at one of these levels here, the candlestick has to touch it, lay across it, or touch it. Okay, it has to have some reference point where it's tethered to these specific key levels. So at 9 o'clock, at 9:01, we have this candlestick right there. Okay, we are inside of this buy side imbalance, sell side inefficiency. Okay, remember, everything after 9 o'clock refer back to these quadrants, octants, and the high and the low of the 7 o'clock to 9 a.m. That's what I'm using. Okay, so doesn't this form a buy side imbalance, sell side inefficiency after 9 o'clock? Sure it does. But now we have to look at where it is in deference to these levels. So we're here, price is anchored and tethered to the lower quadrant level of this range from low to high. So we've carried and brought these levels into the future. Okay, like an algorithm, like a computer program, it'll use information, it'll go back and cull information from a predetermined range of data. Okay, so the array that it's referring back to is this particular price at 28,400.75. And its range will be defined by that candlestick that's tethered to that very one. And there's a volume imbalance. There's a volume imbalance. So that's a suspension block. Price can then be expected to rally higher. Why? Because we've already used this buy side imbalance, sell side inefficiency, and used it to start running here at 9:01. Inside this buy side imbalance, sell side inefficiency, the price run begins 1 minute after the close of that time-based range at 9 a.m. ending time. It rallies higher, creates another buy side imbalance, sell side inefficiency, which is a suspension block. Now we want to see this operate as a breakaway gap. We want to see it really rip higher and take out that short-term high. Does it? Yep, sure does. Now we have this fair value gap. What is that anchored to? Where's it tethered? It's just out there in the middle of nowhere. Well, look at this candlestick's close. 28,508.50. So this thing 8.5. The open on this candlestick is 509. So it's 2 ticks higher. So there is a volume imbalance there. Whenever there's a volume imbalance, you have to include the volume imbalance candle where it has to be tethered to it. Very simple rule. Very, very simple. There's nothing complicated about that. It's very easy. The market trades down into it here, hits it, rallies higher. Now we get to this level, halfway point. Okay, so that's consequent encroachment of the range high and low between 7 a.m. and 9 a.m. Eastern time. We have this inefficiency in here. At midpoint, it was sell side delivery. In other words, it was a down close candle in the way it was formed. So that should act as an inversion fair value gap. And lo and behold, we get it. Then right to the left of that, we have another one. This is a inversion fair value gap. Originally, it was sell side delivery. That means it was produced by down movement and a down close. This becomes the low of that candlestick, which is the open on this. Watch. Look at the open on this candlestick right there. 28,530.00. Okay. This candlestick's low, 28,529 even. So it's only 1 point tapping into that on a wick, and then we rally higher. And then we come back one more time, touch consequent encroachment of this inversion fair value gap, and it leaves the body outside of it. Is that bullish or bearish? It's bullish. We rally up, come back up into this area here, where its first utilization when it was printed, it was sell side delivery. That means if we were bearish, this would cause the market to go down. But it's a little hiccup here, falls short right at the consequent encouragement. And then the next candle we open, trade right back down into, now you're going to see what that level was that I was telling you I was trying to hide it. So we trade right down to that there, the upper quadrant, which would be part of being bullish order flow as it relates to the visual representation of this sell side imbalance, buy side inefficiency. When price is bullish and goes above it, we want to see the bodies avoid getting in the lower half. And now it can't even touch consequent encouragement. See that? It went just to the upper quadrant. Specific levels, not zones. And we rally right back up. Now we're on the other side, closing north of the high of this sell side imbalance, buy side efficiency. While being bullish, that becomes an inversion fair value gap. We open on this candlestick and we come down, and where does it go? It goes just shy of the halfway point or consequent encouragement, and then rallies up. Is that bullish or bearish? It's bullish. Okay, so we start running higher. We took out the buy side over there. And then we go all the way up into the projected high using the low to high. Hammers it beautifully. So we go right close to that new day opening gap from last Friday, which is also the same volume of bounce on the daily chart I told you that we would trade up to last Sunday before the week even started trading, that would go up there and it would sell off. Well, here it is. Same thing happening. Price is going right up into that area. One more spike into consequent encouragement of Friday's new day opening gap of last week, not yesterday's. Okay, so what I tell you? What I tell you about the rules as it relates to new day opening gaps, opening range gaps? You got to have Monday and Friday. Hello. Now the transition. Once we get to here, now we're part of the sell side of the curve. So this is a market maker buy model. You can see all the little parts here that are joined and tethered to the 7 o'clock to 9 a.m. Eastern time-based range, which is the pre-session 7 a.m. to 9 a.m. Eastern time. So eventually it broke lower. I want to show you over here how we used that 28,400 level after clearing it. There's a relative equal lows, and then there's relative equal lows, and there you go. Okay. So when we get into that bit of business here, I want you to think about the daily chart. Okay. When you see this and strip it down to what I teach with very specific key PD arrays, okay, and you see it trade up into it, and I told you I was looking for that price there at 8:14 a.m., and right here at this time, we're there. If you don't have this on your chart, you ain't going to know how high can it go. You see how keeping reference points that are specific to days of the week, times of the day, new day opening gaps from last week. But why did it go down here? But now let's go out to a daily chart and I'll explain why I said what I just did. All right. So we had traded all the way back up into that little inefficiency. So there's that level I told you we would open and trade up into and sell off. Not for a day trade, swing trade for several days. So here's Monday, Tuesday, Wednesday FOMC. And post FOMC, we opened and then straight on up. Then we followed through by opening here and then trade up into the volume bounce and then trade lower. Okay. Where can we reasonably anticipate if it did this and started selling off? Where would price likely go down to? Like, where could you project a reasonable low a day? Now, this is the part where you pause the video. Now I'm going to show you the algorithmic approach to it, what these markets are using. All right. From up here, where could we project the daily low? I mean, you see me short the daily high. So there's now no doubt about that. But on the flip side of it, if I was going to spend the rest of the afternoon and it was not going to do the single straight run down to it, this is what I would have used. Okay. We're here. We're in this general proximity of, let's go to 28,400. That was the level I told you I was going to trade to. That was the sell side I was interested in. That was the level I told you. Okay. Obviously, it was a very specific level with those relative equal lows, but that was the level I called. Okay. So as soon as we went below it intraday on Friday, we can then look at what we could potentially trade to as a daily low. So the first point of reference is what was yesterday's range. That. Okay. So now watch. We had low all the way up to the high. So now we have a reasonable objective to try to get back to 28,111.5. Okay, not bad. Now, because that level's there, I'm going to create another fib and we're going to measure this wick. Why am I picking that wick? Because we're above it and trading down into that wick. Okay, it's going to be a range like a gap. Okay, so you want to measure that. Okay, so now we have 2 points of reference. Now, when I have this like that, I have 2 little sweet spots in the previous day's range, and to the left of that. Why? Because we're going to go back 3 days. Here's this day. So we're trading. This is day 1, day 2, day 3. So day 3, we have a wick we have to contend with because it's below where, well, we're up here and below it. It could trade down into that because looking back 3 days, your entire universe of liquidity and inefficiencies can be summed up in the last 3 days. Once you breach the last 3 days range, then you got to look back further. Okay, got to go beyond 3 days. But as a day trader or intraday scalper, you only need 3 days worth of data. But here we have 2 points of reference in here. All right. So there's 2 points of reference in here that you need to be aware of. You have that and that. If you measure that, that's a consequent encroachment level of 2 projections for a daily low. Okay, this is a high probability draw. So the bulk of the consolidations or bodies will probably respect something like this, or it could be just the very extreme. Okay. All right. And then the other bit of business is we have the low of that wick 3 days ago to here. So now the chart is completely clean except for these annotations. So everything in this area here. So what we're looking in this small little area here, and now I'm going to put a rectangle just to highlight this little space. Okay. So inside of the intraday price action for Friday, we're going to explore what price did with all this information here. We can take the full range from that candlestick away, and there's our data. Okay. So now watch this. You ready? 1 minute. Boom. So where's the market go to? Where's it go? There's our range of key specific levels for projections. We mapped it out. We had the highest point and the lowest point, and we have very specific levels. It trades down into it, and look at this level right here that I shaded out. Isn't that interesting? Isn't that interesting? In that vicinity, we're getting this type of thing. Now, we're going to take that box off because we're highlighting that. Now look what it's done. We trade down into those levels, and we wick down through. Then we rally up. Smooth highs, come right back down into that level again. What is that? It's the wicks on the daily chart that we're treating as a gap. And we're choosing to use the very specific gradient, octant, or quadrants, or consequent encroachment. What's the lowest low it could reach for? What's the highest high it could reach for in that vicinity? Okay. So when you're looking at daily highs and lows, you're going to get a rough idea. It's going to be inside of a clustering of PD arrays, not just a single PD array. You have to blend some things. Okay. And 34 years this November, okay, I've been looking at the market with these types of interests. Like, I want to see, how does it form the high? How does it form the low? How is it forming session highs and lows, like the AM session? How is it forming the high and the low in the 2 hour, 7 o'clock in the morning to 9 o'clock in the morning period? And by studying these things and collecting information on the process of how it creates them, what does that mean? What I just showed you here. If we have the ranges in here like this, okay, that's been defined, and we have a level here, a level here, and a level here. If we see that, we can take the highest one to the lowest one and measure it like this. Right on here. I'm just going to eyeball it. I'm going to spend all that time trying to make it perfect, and then put it right on the lower one, right there. Think about that. Look at that. And think about the logic that I teach you in regards to order flow. If it goes down to half of that, even though it wicks and goes past it, but the body comes right back here and closes, this is our range. Okay. And then in that range, the high, the low, we have a very specific one right here. And then you can do measurements and gradients. Body, upper half. Use the high one, trades down through upper octant, upper quadrant, and fails to touch the next octant. And then up here. Is that bullish or bearish? Bullish. More so because we have the bodies down here, and we can't even leave a body back down inside of this area that was used to try to project the daily low. Now, don't let the amount of selection and measurements dissuade you from pursuing something like this. The way you get good at it is go back and study your old moves like this. Just pick one day a week where you have about, 30 minutes, and just look into the charts and go in and start studying on the daily chart. That's where the information is derived from, not the weekly, not the 4 hour, not less than a daily. It's always inside of the daily chart, because that daily chart is going to give you the cap on the high and the low. Daily ranges are defined by a daily chart. So the information in detail comes from that one particular time frame. Now we're going to focus on applying the opening range gap. So we got to go to 9:30. Okay, so that's the opening price at 9:30 Eastern time, and it's the high of the opening range gap. And then we have regular trading hours. So that is the opening range gap low. Now we can go back into electronic trading hours. All right, so now we can measure and grade that range. So now we have our opening range gap. We have it graded out. Consequent encroachment is here. So half gap, 70% of the time, gets traded to by 10 a.m. It trades to it here at 9:43. Now we have PD arrays that are over here during that 7 to 9 a.m. We're going to blend things here. We have not only a fair value gap right there, that's the 9:30 opening price, that's the tethered level. Okay, so our horizontal levels like this, in other words, the price relative to time. Time is 9:30 opening to 10:30. So we have another time-based range. It's the first hour of trading there. Okay, so we have a low and a high. We have to subscribe to whatever price is going to do in here, and then we'll come back to that information. But for now, there's the hour long of trading. So first hour dealing range low. Now this is the first hour dealing range high. So there's your range high and your range low for the first hour's dealing range. But now let's focus in on the opening range gap. All right, so we have the opening price at 930, and then we drop down from my short, which I don't expect the majority of you to be in that. Okay. Price returns back to 930 opening. So we trade below it, then we trade up, fall short of it, and then we open lower and trade right up into it. This is occurring at the same time we are in an old gap here that's going to act as its first utilization, which is sell side delivery. That means when we're bearish, it's going to be a premium PD array to send price lower. It's being respected there and there. In addition to, we have fair value gap. Okay. All right. Then we have another level here, which is the upper octant. So 930 level. Then we have the upper octant. The upper octant trades up into this one here and this one here. So this is very significant because it's touching two of them. And we'll get to that in a moment. But for now, we're going to borrow this as well. Where are the bodies? In this gap over here. Staying below. Once we close below it here, we opened, trade all the way up to that fair value gap, and then drops down. Open below it, trades up into it, trades lower. We have a gap in here that forms at the upper quadrant. It's a breakaway gap. Why? Because it's above consequent encroachment of the opening range gap. Remember, opening range gap is here to here. So half of that is this red level here. And above it, we're in a premium. If we get a gap after leaving a consolidation where we have 1, 2 candlesticks working inside of a range between two PD arrays, then we have displacement lower. We want to see this act as a breakaway gap. Okay, so nothing gets traded back up into there. We have this candlestick laying on top of consequent encroachment. Over here, we have buy side unbalanced, sell side inefficiency that was salient at this time. Projected over. Its first utilization was what? Buy side delivery. That means if the market's bullish, if it's above it, it trades down into it and sends it higher. That's what we see right there, 901. Now we're looking for prices to try to get back down into regular trading hours opening range gap low. So if we're here, first utilization was bullish, we're bearish now, it's going to act as an inversion fair value gap. We trade lower, we open down here, come up into it, wick, leave no body in it, and come back down. Is that bullish or bearish? Bearish. Now we have this level here. This is the lower octant below consequent encroachment of the opening range gap for Friday. So we're looking at time-wise for here to here, okay? We know these levels. The opening range gap is there. It's there. Like you would see it like this. So that gap is definitely there. So if we know that gap and we grade it, we know how the PD arrays should form, where they're going to form, at what level are they going to react off of. And that's these levels. The high quadrant, I'm sorry, upper octant, upper quadrant, octant, consequent encroachment, octant, lower quadrant, octant, and then the low at the trading hours open range gap low, which was Thursday's settlement price for regular trading hours at 4:14 p.m. Eastern time. And then the market uses this level in here. It's anchored to this candlestick right there. And nothing is happening until we get to this run there with that wick, trade up into the upper half. The bodies are left below here. And we open right where the beginning of this wick is. We open up there and sell straight off. This level is that sell side liquidity pool. We're going to take that level off because it accomplished the method there. And now in here, we have this up close candle laying directly on the lower octant, the one directly underneath half of the gap or consequent encroachment. So when we open here and we trade up, what we're doing is we're trading up into this order block. This is a bearish order block, trades up to it, and then sells off. So the market just drifts down and gets to our regular trading hours opening range gap low. Hammer around in here, back and forth, and then finally gives up the ghost and breaks lower. So we filled the gap. Now we're breaking beyond the gap. So when I see that, I teach you also that you can do the 930 opening price down to the previous settlement price, and then we'll add the negative 50 level, and that'll give you an area in which you can expect a protraction down to that level. And then we can also do it on the -1. Okay, and you'll see there's your low, projecting that, and we got real close to that. You see that? Real close to it. Then trade it up, and we're back inside of all this. So all this opening range gap here, premium is at this or higher in the opening range gap. Premium, trade back down in, consolidate during the first hour of PM session. Then we rally up, take out buy side because it's relative equal highs here, and trades right up into, where's the bodies? Look, where are the bodies? Below upper quadrant, and then it breaks lower. What's this? It's buy side balance, sell side efficiency prior to relative equal highs being taken out. There. This gap is prior to these relative equal highs being taken out. Okay. There's people out there that will say, this is a fair value gap. Once it breaks out of here, if it comes back down into that fair value gap, that's where I'm really interested to go long. Now, and that's not me. I'm interested in that for another reason. It's become a bearish inversion fair value gap. And that's seen like this. Look at that. We break lower after we've taken out relative equal highs up here. The bodies are stopping at the upper quadrant of regular trading hours opening range gap on Friday. And then we had this big displacement lower. And we enter into this area here. We close below midpoint. We open, trade up, and come back down. Opening, trading up, drop back down. So immediate rebalance is something I teach that, like for instance, here to there. It's if you have this candlestick here and this candlestick closes, the very next candle can come right back to that and be an immediate rebalance. Let's say for the sake of argument that this one didn't touch that candlestick's low. It would need to be the very immediate candle after that. And both of them actually do it here. And they're not putting the body above the midpoint of this inversion fair value gap. So it's the gap that's prior to, while bearish, looking for relative equal highs to be taken out. That's your gap right there. So there's your inversion fair value gap. And you got to include the candlestick that has what? The volume imbalance. So this candlestick is touching and is tethered to the consequent encouragement level. So the regular trading hours opening range gap. There's your short for PM session and settlement MOC type thing. If you're a trader that wants to hold on past that. Opening range gap for trading hours. Low. I'll take that shaded area off. And we break lower and trade down below it. So just a wonderful opportunity of seeing how it behaves here. And then after hours rips through here, straight down into this low. These are relative equal lows. That's pretty obvious there. And then it closed right in here, below opening range gap low. So again, I'm going to leave it to you, ladies and gentlemen. Very close call for a projection, just simply using the opening range gap high at 9:30 to the low at previous day's settlement at 4:14 p.m. Eastern time. You can do something like this also. When you have a climax reversal high like that, where it's moved to the zenith point of a turning that high, and then we'll drag the fib to the low right here. Okay, see that? So this is your price range. This becomes a fulcrum point. A fulcrum point is like a hinge. Okay, imagine all of this rally here is a door, and the hinge point is right there. And if the door could swing around and go past this low, it would swing equally right down to that price level right there. And notice how it's also getting very close to where the market had a turning point. So when you get all these things kind of like blending together, it gives you a really rich tapestry to anticipate significant price runs in the opposite direction, or at least be settled for the day. And we booked pretty much the low around those levels that I've shown so far in this lecture. Admittedly, I'm bringing technical science. It's time and price. We take that time, we split it up, and grade it. And then we look for very specific things to form. By knowing these key levels, measuring out, a range and then grading it, when you do that, you're preparing yourself to anticipate a particular formation that would support the idea of where price is going, which you've already arrived at. You start the day with an idea, where is the market likely to go? Just a real easy, low-hanging fruit objective, okay? If you strip it down and say, okay, from the beginning basis is if you just simply look at it like, well, I'm going to show you here. This is the shortcut version, still using my concepts. You don't have to know the highest high. You don't know how to predict it. You don't have to trade it. You don't have to short it at the high and buy it at the low, okay? When you have a gap, just like that, regular trading hours, this is where we opened up on 9:30 Eastern time Friday morning, and this is where we settled Thursday evening at 4:14 p.m. Eastern time. Last print. You're using the closing price, okay? If you are a little bit more comfortable, you can say, okay, where was the close and did it create a short-term high? If we gap higher, if we create a short-term high just in close proximity to where the closing price is, for instance, like right here, you can do this. There's nothing inherently wrong. I actually started my trading like that. Like I looked at the last bit of trading and said, okay, this is the high at 4 o'clock. That candle is high or low. Okay, that if it's higher than the closing price, then I used to use that when I was trading S&P back in the 90s, and I used that as my gap fill, and then I later transitioned to final print at 414. Okay, so there's two reference points there, but you have this one also, which is the finite opening at 9:30 Eastern time. All right, so now by knowing that, we have specific price levels, and we can measure from settlement previous day to open. We have the gap settlement low, regular trading hours opening range gap low, because 4:14 p.m. Thursday is lower when it closed than where we opened Friday morning at 9:30 Eastern time. So there's your gap, okay? And now we can do this. So we have 2 points of reference here, okay? We have low-hanging fruit objective, and then we have consequent encroachment based on 4:14 p.m. Eastern times, standard final print as your opening range gap low. So these two levels are going to be important. The market should drop down into it, but the easiest one to get to is here. Wouldn't you agree? Because it's higher than that one. So now we can go into electronic trading hours, go over to the opening range. All right, so now we have 9:30 open. Once we traded back down into the range, you can trade the retest of that 9:30 opening price there, and small little gap right there. That would be your short. Very simple, not hard. Not hard at all. And you're expecting the easiest objective, which would be the higher level midpoint, which is there. So your entry would be inside this fair value gap. There you go. There's your short. We have the volume imbalance high. See that little small little volume imbalance between the bodies. And then we have the candle wick high. So if you're trying to get this as a short, okay, where would I start my shorting at? Good question. The wick right here, as soon as we breach that midpoint, I'm going to toss in one contract. I'm going to take it and say, I'm going to go one contract right there. Now, scrub this over. See this wick? That's a gap. Measuring from the volume imbalance high down to that wick high, that's your full range sell side imbalance, buy side efficiency. Entry starts here. We'll short at upper quadrant, which is above midpoint of this wick. Okay, and we'll say we're going to toss in one contract around about there. I'll toss in a single contract right there. And then what I want to do is I'll wait and see if it can hit in between these two wicks. So look at it like this. As soon as we get in there and we get above 9:30 opening, I'm going to try to nail something right there too. So we'll say right around 9:30 and above, right there. Okay, may or may not have gotten filled, but I'm just telling you the logic of what I would be doing. If it was to go higher, let me go back down up to this volume balance and then spread this out a little bit. If you get real close to that and enter into this lower portion of that wick, at that wick low and just above it, I would throw in more. So I would start pyramiding the position in drawdown. But the stop loss would have to be above consequent encroachment of this wick. So stop loss would have to be just above there. So stop would be, so on a high volatile day like that, if you're looking at this and saying you're entering here and your stop's got to be up here, dude, that's too much. That's why you should be trading micros. That's how I would manage it. And then once it would leave this area and then completely take out that candle's low, then you can start moving this stop a little bit closer and closer and closer and closer and closer. And this candle takes out that low of that body on a closing basis right there. So the stop can then roll from here originally down to consequent encroachment of the fair value gap and then right above this high. And then it stays there. It lives there and resides there until we get to our target of half gap. And those two levels, first objective here, and then that's the easy one to get to, and then the next one here, which is the classic, which you've been seeing me use and teach with. This one here is using when we gap higher, if there's a short-term high that's higher on the 4 o'clock candle, use the high of that candle. It's easier to get to it. It's faster to get to it. In this case, it hit both of them in the same 1 minute, which is fine. Sometimes it won't be like that. But you want to have your trading when you're first starting to be low threshold. That means low hanging fruit, easy targets. You're not in the trade that long because it's going to be very hard for you to hold it. And you're going to graduate into holding positions longer by learning to do the things I'm telling you to do. Okay. And the only way you get that is by conditioning yourself, just like when you go to the gym, just like when you exercise good eating habits. You're not going to see results until you do time doing those functions and protocols and processes. It's not an immediate gratification. And being comfortable holding trades for a longer period of time comes by way of you practicing that way. You got to stretch beyond the boundaries of your comfort. If you're a 100 handle trader and you want to get to 250 to 500 handle runs, you're just going to have to take the majority of your trade off at your 100 and leave a runner and have no concern with what it does. If it turns back and after it runs another additional 100 handles and it comes back and stops you out and you didn't make anything extra, that's still progress. You've increased the boundaries of your comfort. And that's how you get these bands of scar tissue that you have in fear. You have to break them by pressing into that fear. You got to go beyond what you're comfortable doing and be systematic about it, because you're going to desensitize yourself by doing these things with an indifference to the outcome. For instance, to give you an example, if you believe that we're going to do a full gap closure, which is what you should always try to expect, okay, but you got to learn to take something out of the marketplace in terms of a profit. If you're shorting the opening range gap high here and managing, as I indicated here with hypothetical, okay, we get to the first target, you want to take a partial there. Okay, that's done. And it gets down to standard consequent encroachment of regular trading hours opening range gap. That there, once it hits that, you're done. 80% to 75% of your position should be off. This is how you graduate to, okay, I'm going to wait for full gap closure. And then when it gets there, close the entire position. Or if you want to stretch your boundaries, if you can take one partial off and leave something still running after that, take a partial at full gap closure plus a little bit for spread. By taking the position off and leaving one runner just to see if you can get an overlap of the opening range gap and then send it lower, start protracting lower, and then reaching for things like this. Watch. We have the opening range gap measured, just ballparking it. It doesn't have to be perfect. I don't have time for that stuff. Negative 20. Okay. Very, very easy low threshold just outside the scope of the opening range gap. Very, very nice little handsome little reaction there. Isn't that nice? Then you have the 50 level down here, and it creates a little fair value gap there, and it trades up into that, and then sells off and goes even lower. And then the next one is standard deviation 1 right here. So using just the opening range gap as your entry, your framework, and then expanding beyond that, how far can you reach for it? Right in here. It goes a little bit more, but you're going to get mad about that because you didn't get all that when you had this as your final exit. Or if you know that you can potentially try to hold for these positions, the bulk of your position gets taken off at full gap closure. Something gets off at half gap. The bulk of your trade gets off at full gap closure. Then negative 0.2, there's another partial because it could just go below the gap low and then rip up higher. That's why you take that. Then you take off at negative 0.5, a partial, and leave something so that we can reach for one standard deviation, negative 1.0. And that's what this level is here. And then if it goes beyond that a little bit and keeps on going, who cares? You literally went in there systematically and shorted the high of the gap, partialed halfway when it's 70% likely to do so, and you give yourself that cookie, okay? And then you remove the risk. Put your stop in a position where it covers costs and buys you a pizza dinner. And then let it go. And then when we get to full gap closure, the bulk of your trade that allows you at least to have 3 contracts of like a micro, okay? 3 micro contracts still left on once you take everything else off at full gap closure. Negative 0.2, take a partial. Negative 0.5, take a partial. Roll the stop above here and see if you can get that negative 1. When you get it, close the trade. Be done, walk away, moonwalk out of there, just kiss your wife, bend her over, smack her ass, tell her we're going out to dinner tonight, and there it is, okay? Don't do that. She'll probably get you for domestic abuse. But the point is this. When it gets to these levels, you got to have an anticipatory price skill that tells you this is an action point. It's not a watch and get greedy and, oh, it's going to keep going lower. It's going straight to hell. No, you got to do something with it. It means take it off. Or if you are thinking it's going to continuously go lower, because it could happen like that, what do you do when it gets down to here? Roll your stop up just above here. And when it goes down here like this, and so as soon as you breach on a closing basis between that level and that level, which would occur right there, save the stop because it's probably going to come back and take that out. So you're gonna risk that final little partial that could have been perfectly taken off here, and a better exit than where this would be, indicating that you'll have to kill it. So the difference between where you kill it here and where you could have got out when it hit that, that's the stuff you're going to have to live with, folks. That's trading. There's many times I've been in trades where I've had a unrealized profit on remaining portions of a trade, and my gut, my experience, my intuition was telling me, just dude, close it. But I just wanted to see if I can capture a little bit more out of it. And if it didn't give it to me, I still had the lion's portion of the move already in my bank. Like, I don't care really if it turns around. But then when it happens, it's like, yeah, I knew I should have did that. So like Larry Williams said, you're never right in this business. Okay. You're never right. You're never, never, never right. Okay. But if you aim for precision and you operate with processes and protocols that leads towards that goal, but you're realistic with your engagement with price and you're not beating yourself up, you're going to do very, very well.